Wait, you mean I have choices in what interest rate I can get? Yes. Today we're breaking down permanent versus temporary interest rate buydowns, how they work, why you'd use them, and which one might be the better move for you. We're going to start with the most common way to get a lower interest rate. Permanent rate buydowns, the long game strategy. Imagine you can pay a little extra up front to get a permanent discount on your mortgage rate. That's exactly what a permanent buydown does. In the mortgage industry, we call this paying points. How it works, you're going to pay discount points at closing. If it's a purchase, it's out of pocket. If it's a refinance, you'll likely roll it into your new loan amount. Each point equals 1% of the loan amount. It will lower your rate by whatever the current market dictates that a point will get you in savings. One day, it could be 0.25% off your rate. Another day, it could be a half. This changes hourly and all comes down to the demand for mortgage bonds. There's no rule of thumb for this, and a good loan officer will give you options. It's all about finding that break-even sweet spot and pairing that with how long you plan to own this home. Important to note, the lower rate applies for the life of the loan. So let's run through a hypothetical example with easy math. You're borrowing $400,000 at 7%. You decide it's worth it to pay 1 point to get your rate down, which equals $4,000. Let's say the market dictates your rate drops to 6.5% permanent. That would save you around $133 a month for the life of the loan. For a $4,000 cost, $133 a month would break even in approximately 2.5 years. Is it worth it? Maybe, maybe not. If rates don't go down and nothing changes in 2.5 years, you win. You're forever saving interest on your mortgage. And over 30 years, this really adds up. I win! Okay, now let's talk about a different strategy called temporary rate buydowns. It's a short-term hack. Temporary rate buydowns are like training wheels for your mortgage. Your payment starts off lower, gradually increasing until it reaches the full market rate that you've locked when you got your mortgage. It's not an adjustable rate mortgage. Those work differently, and depending on the type, can change very often according to our economic state. Temporary rate buydowns are more of an incentive adjustment, and it's predictable and still fixed after the temporary rate period has expired.
That sounds nice.
Here's how it works. These buydowns can come in a few sizes, 1 year, 2 year, or 3 year. A 2-1 buydown is the most common type, as it usually falls in the category that sellers are willing to concede. A 2-1 buydown means that you'll receive 2% off the first year, 1% off the second year, and then in the third year, you'll go back to the rate you locked when you got your mortgage. 3-2-1 would mean 3% off the first year, 2% off the second, 1% off the third, and then back to the original rate on the fourth. You can probably assume what a 1-year buydown would do. Here's an example. Let's say the market rate is still 7% on that $400,000 loan. On a 2-1 buydown, it plays out like this. Year 1, your rate is 5%, so that's 2% off of 7, and your principal and interest payment is $2,147. Year 2, your rate is 6%, and your payment is $2,398. Year 3 and beyond, your rate goes back to that 7%, your payment is $2,661. That's over $6,000 saved in just 2 years. Not a bad deal, right? Temporary rate buydowns are extremely popular when there's a sentiment or expectation that rates will come down. Nobody ever knows this for sure, but you're buying some time for your income to grow or betting on a market correction. Or you just take that nice bonus to give you some reprieve as you ease into your new housing situation. Think of it as your payment being subsidized temporarily. One other very important thing to note, this is your money, which means it sits in an escrow account and offsets your mortgage until the time is up. And why does this matter? It matters because if you decide to refinance, this money will get credited back to you as a principal reduction. That's a nice incentive. Versus, if you decide to refinance and you bought your rate down permanently, that money is gone. You bet and you lost. See the difference?
It's gone. It's gone!
Okay, we've talked about the two types, but this is important. Who pays for each of these? Permanent buydowns to start. You pay for it yourself, or the seller can agree to cover the costs. The only restriction is that certain loan products can cap your seller concessions, and it might not be able to cover the full cost of the permanent buydown. Temporary buydowns. This one is paid by the seller, not the buyer. Remember, this would be a seller concession, so you can choose if you'd like for them to cover your closing cost, permanent, or temporary rate buydowns. Of course, this is never a home run. They'll likely oblige only if the market is slow enough to offer this as an incentive, which is why it's always advantageous to purchase a home in a slow market if you can be in a position to do so. That said, you can always buy your rate down permanently. If you can get sellers to concede some money, You can also combine a permanent and a temporary rate buy down for even more relief. I've had buyers bring $0 to the closing table and get rate relief temporarily and permanently. It's not common, but it does happen.
Oh, does it?
It does.
So when should you use each? Go permanent if you plan to stay in the home for a long time, you have extra cash up front and want to lock in a lower rate, or you want stable, predictable payments with no surprises. It's best for buyers who are playing the long game and want the security of a low rate. Or maybe borrowers that are purchasing investment properties and are trying to get their payment to cash flow at fair market rent. Go temporary if you expect interest rates to drop and plan to refinance before the full rate kicks in. You want lower payments while you settle into home ownership, or the seller's paying for it, making it a no-brainer. It's best for buyers who want to ease into home ownership or plan to refinance soon. I know these may be new concepts for a lot of you, but I really hope you found this helpful. I get these questions all the time, and I thought it'd be good to put in video form. So that's a wrap on permanent versus temporary rate buy downs. Now you know the pros, cons, and how to pick the right strategy for you. Before you go, don't forget, please like this video if you found it helpful. Drop a comment with your questions. I read every single one. And please subscribe so we don't miss out on more game-changing mortgage tips. Buying a home is one of the biggest financial moves you'll ever make. So let's make sure you do it the smart way. Thank you so much for watching, and I'll see you on the next video.